Welcome to TradingPennies.com Chart of the Week, where every week we will examine the trading strategy behind one of our explosive daily stocks picks. All of our strategies are covered in detail in our manual, Learn How Professionals Trade the Penny Stock Market, available on our site at trading-pennies.com. In this video, we're going to continue looking at the 6 most profitable chart patterns that you need to become familiar with to become successful trading the penny stock market. Today we're going to look at the profitable but risky, the Volume Climax. Volume climaxes are highly predictive of an imminent change in trend. This pattern is characterized by a sudden and dramatic increase or spike in both price and volume in the direction of the prevailing trend, only to retreat on lighter volume. Volume climaxes become more predictive towards the end of a long move, or as a stock nears a significant resistance or support level, or when a stock price rises far above the traditional moving averages used by the majority of traders, otherwise known as a stock being extended. Stocks for the most part ebb and flow between a range formed by a relative balance between the forces of buying and selling pressure. A volume climax represents an extreme imbalance in market psychology between these forces. Since most stocks tend to move towards relative equilibrium, or a perceived value, fair value I should say, these extremes in price movement tend to be short-lived and quickly reverse and snap back towards the norm. Classically, those that hold on to these extremes, anticipating further continued price movement, do so based on greed, and thus the basis for the classic saying, bulls make money, bears make money, but pigs often get slaughtered. Since the majority of traders do not have the ability to short penny stocks, we look at volume climaxes to the long side as opportunities to scalp profits on the upward advance, or scalp profits on the rebound to dramatic falls into strong levels of prior support. These are not, and we repeat, these are not trades for the weak at heart or inexperienced. You have to be nimble and have a strong constitution for these types of trades. If you're not, we strongly suggest do not enter into these types of trades. To the upside, you have to know where all the significant key resistance levels are by doing multiple time frame analysis. As noted in our manual, the greater number of times a price level, trend line, moving average, etc. turns a stock away when approached from above or below, the greater its perceived strength is recognized by those who trade based on these and the time frame in which they tend to trade. What we do is look for convergent points amongst these points on multiple time frames and view these as truly significant key pivot points and thus likely targets to look to take profit. As can be seen with this example, the daily chart demonstrates significant resistance points at the 0.12, 0.16, and 0.23 price levels. The weekly chart shows resistance at the descending 20-period moving average at the 0.21 price level and the 0.16 and 0.10 price levels. For our purposes, the monthly chart was not useful and not considered for this example, although traditionally we had always incorporated. Thus, to those who had a position in Lehman's, as we did, on its volume breakout from a long consolidating base, we looked at the 0.16 and the 0.21 to 0.23 range as key resistance levels to watch price volume action and places to take profit in lieu of the price volume action that preceded this move. As can be seen on the intraday chart, heavy volume came into the stock and the price action went vertical into our key resistance level at the 0.16 price level. Due to the degree of extension above the underlying support of the intraday 200-period moving average, we took full profits here. Since the greatest rebounds occur on the initial pullback, we quickly looked at the intraday chart to see if there were any significant support levels where we could play a rebound off of the volume climax pullback. When trying to profit from rebounds from volume climax plays, only look to prior significant support levels in multiple time frames. When you see convergence amongst these support levels within multiple time frames, these are the levels we will watch the price volume action of the stock carefully, as these represent truly significant pivot points. Rebound plays from volume climaxes can be similar to the well-known axiom trying to catch a falling knife. To this end, when looking for prior support levels, you want to look for those of greatest strength. We first noted that the 0.10 price level coincided with the 8-period moving average on the daily chart, which can be seen on a prior slide, as this represents a significant moving average to those who trade in this time frame. Due to the degree of extension above the intraday 200-period moving average on the intraday chart, we looked at it and the 0.10 price level as being a key pivot point in this time frame. We also noted that this price level was a convergence point with an uptrend line drawn off the intraday lows, so we placed a bid at the 0.10 price level and got filled on the opening spike down in morning trade. Now in position, our concern was our upside price targets and our stop loss. We saw the 0.16 level as a significant resistance and an early morning volatile trading, and where we were prepared to sell the majority of our position. We used our rules for the break of the intraday 200 period moving average as our stop loss for the remainder as it rose to a position of support, closing the degree of prior extension. To our amazement, the price volume action vaulted right through the 0.16 overhead resistance level and quickly to our next target price at the 0.21 to 0.23 price range, and where we sold all of our position. Some may ask why we didn't let it ride and hang on to our position as the stock continued its advance. Our reasoning was the 0.21 to 0.23 price range were key resistance points on multiple time frames. The stock was well extended above all major moving averages on multiple time frames. The volume had exploded over the course of the past 2 days, and we saw convergence with this price resistance level and an intraday consolidation projection target, which will be discussed in a future video. Mostly, we had made a significant profit, remembering that a profit is only made when you sell at a price level that's higher than when you entered. As a rule, we at Trading Pennies do not play any other than the initial pullback from a volume climax drop, so we moved on to our next trade. Until next week, from TradingPennies.com, this is Thomas McClellan, where our goal is to help you learn to become successful trading the penny stock market.